Tracy.
I was actually talking about a small bounce back because of the lower prices in stocks now.
Yeah. So oil prices did crash quite a bit Friday. Yesterday overnight in the US session, oil prices have come down quite a bit. So yes, so I think we'll get a bounce, but I don't think it will sustain for any meaningful amount of time. So, so we'll see where it can go. 1 minute.
Yes, sir.
Yeah. So a lot of technical damage on the charts, and given that the US market is now down nearly 23%, Indian market should have been down 30 or 40%. So if a 30% correction comes, so we are looking at 13,000 or so on the Nifty, which is where I think we are headed long term this year. So I know it's a little 2,000 points away, but I'm very sure that's where we are going minimum. And if all hell breaks loose, then the COVID lows may get revisited at 7,500. Very, very possible these levels. They are scary. You probably are unbelievable, but you'll see the real reason why the market rallied from 7.5 to 18.5 had nothing to do with fundamentals, right? It was cheap money available from low interest rate environment created by the central banks. Okay, please understand that. The market was clearly out of touch with reality and was going vertically up. And now the central banks are raising rates. So it's going to vertically go down. So that's the essence of how fundamentally things work. Okay, now before I do anything else, let me send you an invite to this material so you guys have a link. Guys, I'm going to put this in the chat. Yeah. Access it immediately, because if you wait for 1 or 2 hours, the link won't be valid. You see the link, students? This is your class. Yes, this is your class material. It's got pretty much all the modules in it. So you'll see the class PPT and some other material. This was from a full 48-hour course I had taught earlier on. So you will have adequate material and other things there in the class. So I also asked you guys to start your virtual trading. Have you been virtually trading your account? Have you set up that? That is your internal assessment. Yes, students?
Just started with that, sir.
Yeah. What about others? Nidhi has started. What about other students? Have you guys started trading? Students, you're going to be assessed based on that simulation. That simulation I have assigned is 30 marks of your assessment. And then there'll be 20 marks, another assignment will be given. So take that seriously, students. Yeah.
Yes, sir. Yeah.
So next class, students, I want you guys to come up with 3 or 4 trades that you have placed, the reasoning behind, and I want you guys to present on it. Are all of you hearing me?
Yes, sir. Yeah.
Nidhi hears me all the time, it feels. How about the others?
Yes, sir.
Yes.
Okay.
Could you repeat, sir?
Yeah.
Could you repeat, sir, once?
Yeah, so basically I have given a virtual simulation assignment to everybody. So the platform is iqoption.com. Just set up the demo account there. You don't have to use IQ Option. You can use any other account, but set up a demo account only, no real account, demo account. And you have to place trades and analyze them with graphs and give me the reasoning as to why you bought also. For example, now we're going to go and look at some charts. So I'm going to show you the markets that the world of markets that was this week, and let us have a look at some. Okay, so along these lines you are supposed to do. Okay, did you see that link I shared in the chat? Yes, no?
Yes, sir. Yeah, it's okay.
Okay, okay, access it fast because it sometimes it just gets deactivated. Okay. All right. Okay, so here go the graphs. So this is the Nifty first. It's taking time to load. Okay, students. So this is the US market, which also gave a very big downside break. As you can see, all week. So I will add the Bollinger Bands. So you can see how the market has come crashing to the lower Bollinger Band, and it is sloping down, and it is dangerous and indicating further declines. You can also see that line below, which is the MACD. You can see how it is crossed and given a bearish cross. Okay, so that's the Dow Jones for you. So we'll switch to our market next. Okay, so look at Nifty again, hitting the lower Bollinger Band, sloping below, right? Some bounce, like you said, can come because it has gone below the lower Bollinger Band. But my guess is the lower Bollinger Band, if you look, is round about what, 1537 or something like that. So there are many fund managers who were talking yesterday saying that if the Nifty were to close below 15,350, which it did, another 1,000 points can come. So the risk is there to the downside. Yes, the RSI is now below 30, as you can see on the top. So it is oversold. But sometimes oversold can get more oversold. And another interesting thing, if you watch, is the 200, that red line, 200, you don't really see it here, but it has started to decline. Usually when the 200 DMA, the long-term trend, starts to decline, you will have very big falls in the market. So my guess is the first half of next week, you can probably see more of a fall. Then probably somewhere of a bottom near 14.5, I think, to 15,000 level, you can see some kind of bottom. So and then maybe a rally. So that's the thing. But I think the first half, Monday is a US holiday. So first half, as we look at this chart, is more telling. And I think market is not very oversold on the weekly chart. Again, you can see how it cracked the lower Bollinger Band below 15.5. Okay, students, below the Bollinger Band crack there, it has gone at the lower Bollinger Band on the weekly band. So again, when it goes below the weekly Bollinger Band, some kind of bounce can happen. But you are going to see that 15.5 is probably the level where it probably is going to get capped. So my guess is, look at that red line on the weekly chart. Can you see that 200-day weekly? Guys, am I audible?
Yes, sir.
Yes, sir.
Yeah.
Oh, okay. Okay. So some of you, Chavi had sent me a message saying she has connectivity issues. So I was just wondering. So, but anyway, okay. Now, so you see that red line there, students? 200-day moving average.
Yes, sir. Yeah.
Yeah, so that is 13,172. So I was telling you how 13,000 it can come, the market. As you can see, since the pandemic, which is on the leftmost corner, the market has not touched that red line, right? Not even come close. Now it is getting there. So I would not be surprised if 13,000, that red line, breaks eventually at the end of the year. And you're going to see some really big selling coming in. So yeah, so I think this year is not going to be good. So if there are any big bounces, use them to sell, not buy. If you're a long-term investor, keep your SIPs, keep them going. No problem with that, because eventually the market will come up. But I think we are headed for a 5-year plus bear market. I think there is every indication that big recession is coming in the US, and I don't think India can escape it. So my view is 5 years down, Indian investors have not really seen a very big bear market. They're going to see one. You may see, look at that pandemic low there on the leftmost corner of your screen. That is trading at, that is almost coming in at 7,500, from which the market rallied 1,100 points plus, right? So if we give up 5,500, half of that, we are going to be at 13,000 or so, which is not bad. Markets cannot go straight up, right? What goes up must come down. But you can also see the middle dotted line is the 20-day moving average. How it has crossed, the 20-day green line has crossed below that blue line. You see that? The last time that happened was in the pandemic. The middle dotted green line is crossing below the blue line in the middle. Can you see that, students?
Yes, sir.
Yes, sir.
It has not happened since what? The pandemic, some 2000 years, some 2 years back, 3 years back. So that was when it all started. So when that line crosses, usually you're going to get a very big fall. And we started the fall. I don't think we are done quite yet. And we may fall a bit more next in the weeks to come. So the trend is down, short-term trend is down. Like somebody else, I think Mahesh pointed out, it is oversold, as you can see. But weekly RSI is made a new low, which is not a good sign at all. It can get even more oversold. Some bounce may come, 200-point bounce can come anytime. But if I were a betting man, I would be selling that and not buy. Okay, students, any questions on that? Any questions, any thought process, any alternate ideas?
No, sir.
Okay, students. So that's your Nifty for you. Now let's look at a few other markets here. So the stocks that are holding up of this market. Are Reliance, and it has started to crack. Friday it came back a bit, but you can see. So the oil price crash would imply, right? I think Reliance will crack, and I think it will take the rest of the market probably down with it, is my guess. So Reliance was the only stock that was holding up the market here. Yeah. And it has finally crashed. So I think that is a warning sign that the rest of the market is also in trouble. Okay, students. Now, other areas of the market, the bank Nifty is another area. So the point is, guys, so if I am taking a bullish trade, how will I take it? Last week, I was explaining this to you. So let's look at Nifty Bank also. So Nifty Bank, again, it has crashed. It has hit the lower Bollinger Band and looks set for more declines. So the point is this. So how am I going to take a trade, bullish or bearish? What do you think? So as I told you, I'm going to use Bollinger Bands and MACD to take trades. Yeah. So Bollinger MACD negative signal, and it is in the second half of the Bollinger Band below the red line. So this would be a bearish setup. Yes, but you also want to make sure that market is not oversold, as it can bounce anytime. So if it goes, let's say 200 points below the lower Bollinger Band, just look for opportunities to cover up and wait for it to bounce. So in this case, the lower Bollinger Band of the Bank Nifty is 32,609, and it is above. So I think the downtrend can resume here. So this is a good, actually not a bad short entry here. Yes, but what should I target? Target is 32,200, at least the previous lows. And if that breaks, then we are looking at, some people are saying even 3,100, 30,000 levels of the Bank Nifty. So the point I'm trying to make here is the Bank Nifty is about 40% weighted in the Nifty. Okay, so when the Bank Nifty crashes, the Nifty will also crash. So Bank Nifty is also leading the declines. So FMCG was holding up, but even FMCG started cracking on Friday. So look at ITC here. This has been one of the best performing stocks in the Nifty. You can see how it is, but it has started cracking off late. Yes, so FMCG stocks are also looking in trouble here. Yeah, so where is the market going to go up? For all of you who think the market will go up, who is going to lead it? Right? There must be some frontline stock. One of them was Maruti, and it started cracking as well on Friday. Maruti was making highs recently, even when the market was going down, but Maruti is looking very ominous here, because after a long time it was holding up, and then yes, in Friday's session it went down and touched the lower Bollinger. So you can see this constricted pattern, it can widen. So once it touches this type of position, the MACD finally crossed to negative territory. So this has the makings of a very big decline here. My guess is it may go down 1,000 rupees to that previous low near at least 700, 800 rupees, all the way probably going even to that previous low near 65. Very, very possible that it is just getting started on a big decline here. So all the stocks, my point to you guys is, when you analyze the market, look at all the frontline leading stocks. Yeah, and see where the strength can come from if the market were to go up. And right now, to me, it looks like the market is on borrowed time a little bit.
Sir, Nifty Bank and Nifty, they are two different stocks, right?
Nifty Bank and what?
Nifty, just Nifty, because
yeah, so Nifty Bank only contains the banking stocks.
Okay. Yeah.
Nifty contains the 50 largest companies from all sectors.
Okay. Yeah. Got it, sir. Thank you.
Yeah. So the Nifty Bank tends to be much more volatile than the Nifty index because it's got private and public sector banks. So it tends to move in bigger increments, but nonetheless, it's worth watching. Typically, in the bull market, Nifty Bank will do a lot better than Nifty. But in the bear market, it's the other way around. Nifty Bank will tend to do a lot worse than the Nifty, because banking stocks are usually the ones most sensitive to any financial trouble. So right now, the problem is this. I'll show you this. Why is banking getting in trouble? So this is the India 10-year interest rate. And look at this. So it is after RBI started hiking and inflation pressures coming. You guys watched the inflation numbers this week?
No, sir. No.
Yeah. PPI came in at 15%. So PPI is now higher even than the CPI. I mean, the wholesale price index, that is WPI, came higher than the CPI. So when WPI is higher than the CPI, corporate profitability will eventually erode because companies will not be able to pass on the prices to consumers. And as a result, profitability will erode. And when profitability erodes, obviously share prices will come down. So this is why I think the stock market, because of all these inflationary worries, is coming down. Because I think ultimately stock markets go up if profitability goes up. Because long-term profitability of companies is now going to be called into question. And I think because of that, earnings revisions to the downside will have to happen. Analysts will start taking down numbers on companies. So expected earnings declines will be factored in, and the stock market is quite not factored in. It's still expensive on something called a PE basis. You all know what PE ratio is, right?
Yeah, yes, sir.
So price to earnings ratio, typically, if a market is fairly valued, it has to be around about 15 PE, but we are still above 19 PE on the Nifty. So from 19 to 15, if the market were to come down to on a PE basis, imagine that. That's my guess. That's another 20% crash from these levels. Yes, and put a 20% crash from these levels. What do you get? You get about 12,000 on Nifty. Yeah. So fundamentally and technically, the market is not looking good here. So that's something to keep in mind. Interest rates, as you can see, are at all-time highs. Right. So if I were a portfolio manager, what am I going to do is the larger question. So I would look at fixed income investments, particularly sovereign gold bonds. I think gold is going to do well in this kind of an environment long term, though in the short term, it is kind of coming down a bit because Fed tightening monetary policy is not very good.
Sir, change in these price indexes like CPI, PPI, that will mostly affect the FMCG sector, right?
Yeah, I mean, it will affect everybody, right? See, remember, at the end of the day, it's interest, cost of funds, right? If my cost of funds is going up, right, I'm not going to be able to raise money fast, easily from the capital markets. My cost of capital is going up. My interest expense is also going up. So my profitability is going to come down, right? Regardless of which sector you're in, yes, FMCG will be impacted a little bit more, but everyone.
Okay, sir. Thank you.
Any other questions, students? Students, just a moment. Okay, students, coming back to topic, this gold price is considered, gold is considered as an inflation hedge, right? So typically in periods of inflation, gold has to go up, but off late, if you look, gold has been coming down as well, but not as much as the stock market. So if you look at since the beginning of the year, gold is still up on the year, whereas most stock markets are down. So I think that trend will probably continue. So yesterday, this happened in the oil market, very, very interesting. And I think this is where the trouble is going to start. And I think this is an indicator. So you can see how what happened in the oil market yesterday. Very big fall in the oil, big red candle there. That is telling you that the world economy is not going to survive all these rate hikes, right? You're hearing me, right, students?
Yes,
Yes,
sir.
sir.
Yeah,
Yes,
yeah,
sir.
wonderful.
So the oil price is starting to come down, and I think it is suggesting that when the oil price peaks like this, it went to a high we saw in the Ukraine war, then it went tested it, could not sustain above, now it's rolling over. So this is not an indication of good economic health. Okay, so when the world's economy is not going to suffer a big slowdown, oil peaks and starts crashing. Okay, so this is bothersome. Yesterday alone, I think 6% fall happened. So this is indicating that the world's economies are slowing and possibly eventually goes into a recession at some point of time. You can see, despite all this big move in oil is just reaching those levels which we saw back in 2008-10. Oil peaked round about the same level. So my guess is, you can see how it has touched the top of the Bollinger Band and put in a reversal. So I think the trajectory, oil may give a 30 or 40% crash here if we are heading into a recession. Okay, so that's something to keep an eye on. The other one, which is also an indicator of global economy, is copper, and you can see that crashing as well. That's a bigger crash. So copper usually, many people say that copper is like a PhD in economics metal. So copper can telegraph what's going on in the economy. So you can see how it has crashed all the way from nearly 5 mark to 4, almost 20% crash in copper in the last 3-4 months. So this is again a sign that the economy is not doing well, and we may head into some trouble going forward. Okay. Then, of course, all the speculation. This is why I think you should never touch cryptocurrencies. I hope you guys don't ever touch it, because here is the problem. This is a very big crash. Bitcoin is now down from 65K to about 20K, and it will probably go to 5,000, I think, when all is said and done by year end. I think this is a very big trend change. You can see how the Bollinger was narrowing and it just widened and started coming down. So the problem with crypto is, even if you own crypto, you may not get your money if you sell it, because all these exchanges are not like NSE, where when you buy Reliance or sell Reliance, you get money in your brokerage account, right? So this is the problem. So these crypto exchanges are not regulated. And so they basically can cheat you and take your money and run, right? So this is why crypto is not a safe investment. Just because the price was going up, some people bought it. I think this is a sign that there is very big trouble coming in crypto. Many of these other cryptocurrencies, which were supposed to be stable coins, meaning linked to the dollar, have collapsed. So this cryptocurrency collapsed from 14 to close to 0. Okay. if the monthly graph should be alarming to you. In fact, I think it reached almost just at some point 100. Okay. So I don't know. This to me looks like a Ponzi scheme, right? So when cryptocurrencies, so this coin was thought to be linked to the dollar, but obviously the guys who created this did not have the collateral to back it up. And so this is very scary. I mean, Bitcoin itself is down 70%, right? From 65K plus down to 20K. And I think this is a very big danger that simply you should not buy stuff. This is what Warren Buffett says. Buy a business, not a stock, right? So you understand what the underlying business is worth, right? Then you buy it. You just don't buy something because it goes up, because then it can go down and you won't understand why it went down, because in the first place you didn't understand why it's going up, right? So this is scary stuff, right? Crazy. All these currencies have just crashed left and right. Okay. What else are we going to look at? Okay. Those are the markets for you now. I mean, my biggest concern why I think the markets have not bottomed yet is because of this indicator. This is the Indian Volatility Index. You can see how there is, so typically you can see on the leftmost screen, you can see how during the Russia war, actually, the VIX actually started spiking. When it went above 30, 35, in fact, during the COVID crash, it went as high as 80. There is panic. Usually when market crashes and panic happens, there is a bottom that can form. Here, there is no panic at all. The VIX is only 22.75. On the right-hand side, you can see that the US VIX is higher than India VIX. India's market volatility should be a lot higher. We are an emerging market. So my point is there is no panic yet. People are still trying to buy whenever the market falls. So I think the retail sentiment is still too bullish, and as a result, that is contrarian bearish. Okay. So my point is this. So markets are yet to bottom. Okay, students, any questions on whatever is being discussed so far?
No, sir, not on my end.
So next week, you are going to present some ideas like this for trading. Yes, each one of you should present 2 ideas via Zoom.
Sure, sir. Sir, we have to show the trade or just.
Yeah, you have to place the trade in your virtual account, and you show the reasoning like what I have just shown you.
Okay. Yeah.
Like this.
Yeah.
Yes? You can?
Yes, sir. Yeah, sure.
Yeah. So ultimately for your virtual challenge, you must do at least 20-25 trades. Then you guys can get good at it. I will show you that interface once again. Those of you who came late to the last class may have missed this. So this is the interface. I'm using this. You are free to use anything you want. I don't mind at all. But this one is, they give you a 10,000 virtual account. My internet here is a bit slow, so. So you can log in with your Gmail, which is what I have done. The reason I use this is you can gain a lot of insight into a lot of international markets, international stocks, so many different things. Because here in the NSE side of things, you'll be only looking at Indian markets. So you need to broaden your horizon a bit and understand so many other markets are there. So they give you a 10,000 virtual account and you can start trading. So use investing.com's charting, that's slightly better. So you can just do your demo account. So you can just look at the trade account. They would have given you a demo account here. Here you can use a stop loss, etc. So at any given point of time, do not risk more than 10% of your account balance. So then you are safe. It's taking time, but you get the picture. Okay, so I'll start the class now. So I believe we stopped on futures margins. Okay. So that's where we will start. Okay. So this is where I stopped, right? If I recollect. Yes, students?
Yes, sir.
Yeah. So you understand how to calculate initial margin on a futures contract. So that is based on mu plus 3 sigma, where mu is the average change in price and sigma is the standard deviation of the change. So if you do that, you can calculate your initial margin. Okay. Now, let us apply this to a real situation. So you are taking a long position in 2 December contracts. Okay. Now, there are 2 margin requirements. One is the initial margin and the other is the maintenance margin. Okay, students. So initial margin, you already understood how to calculate. Now, maintenance margin, why do we have to have maintenance margin? So maintenance margin is created to assess margin calls. If your account goes below the maintenance margin, a margin call will be triggered. Okay, students, are you understanding? If your account falls below the maintenance margin requirement, a margin call will be triggered. But what must you do? You must bring the account back, not to the maintenance amount, but to the initial margin amount. Every time a margin call gets triggered, you have to bring your account back up to initial margin levels. Are you understanding, students? So you will have an account, you will have an initial margin which is required for you to trade. Once the account falls below the maintenance margin, you will get a margin call. Yes? Yes? Once you get a margin call, you have to bring the account back to the initial margin. So in this case, the initial margin requirement is 2,000 per contract. We've taken a long position in gold. What does that mean? What do you understand by a long position?
We bought.
Correct.
Yeah.
Correct. So we bought 2 contracts of gold. So the initial margin requirement is 2,000. The maintenance margin is 1,500. So when will we get a margin call? So 2 contracts, 2,000, 4,000. So when will we get a margin call? If the account balance falls below what level?
Maintenance margin.
Correct. So which is 2 into 1,500, 3,000. Yes. So when you get a margin call, what must we do? We must bring the account back to 4,000, which is the initial margin.
Yeah.
Is that correct? So this is how this margin call. I'm very sure some of you may have traded futures contracts. Have you traded, any of you? Yes, I don't trade it because of this margin call thing. I only do options, but futures contracts always have margin requirements. So this is how initial and maintenance margin. Now we'll go through a real example and see how this margin call is being triggered. Okay, students. So you start the account with 4,000. You put 4,000 in your account. You have your starting price of gold, which you bought 2 at 900. Yeah. So you start with 4,000 margin, initial margin required. Now the gold price falls. So let's see if we can do this in Excel. So you will logically understand. This Excel is uploaded also, so you can later on access it, no problem. Oh, the margin call thing is not yet. But anyway, no issues. It is in another spreadsheet of mine. So anyway, I'll logically explain this to you. We can you can actually open an Excel and work this out as well. So no big deal. Anyway, so look at this, students. Now On 5th June, what happens? Price falls to 897. Yeah. So we are trading 2 gold contracts and the lot size is how much, students? Tell me what the lot size is. Yeah.
Usually it's in denominations of 50 maybe.
This question, what is it given?
Okay,
100 ounce.
100, yeah.
The lot size is 100. Okay. So 900 to 897. So we have lost 3 rupees, $3. Lot size is 100. So 3 into 100 and on 2 contracts, 600. Are you following? How
Yes,
that
sir.
600
Yes, sir.
is coming? Students, all of you, are you following?
Yes, sir.
Okay. So now our balance is 3,400. You have to subtract the 600 from the initial margin of 4,000. 3,400. Are you getting?
Yes, sir.
Okay. 3,400. So that is the balance. Will there be a margin call?
No, sir. It did not go below the maintenance margin limit.
Correct. So it did not go below 3,000. So then we don't have a margin call. Now, again, 1 week later, price comes down to 893.30. Yes. So from what is our loss from 897 now? 370, $3.70 we have lost on 2 into 100, 740. Yes. Yes, students, are you getting 740?
740 plus the last 600.
Yeah, so 740, forget the cumulative loss. You can just add that 600 we've already lost, 740 we've already lost. But 740 used as a reference point, your balance was 3,400. Subtract 740, what do you get? Already the account balance had come down to 340. We had adjusted that. 3,400, sorry. Minus 740. You get 2,660.
Yes, sir.
Yes, sir.
Yeah. So do you think there will be a margin call now?
Yes, sir.
Of course, because it has gone below maintenance margin. But when I bring the account back, I should bring it back to initial margin, right? So I have to add 4,000 minus 2,660. So 1,340 rupees I have to add to bring the account back to initial margin. Are you following?
Yes, sir.
Okay, so now the account has been brought back to initial margin of 4,000. Okay. Now watch. Next, what happens? Gold falls again to 887. So you are losing how much? 630 now. 2 contracts, 1,260. 4,000 already we brought the account back to. 4,000 minus 1,260 is what? 2,740. What do you think? Margin call? No margin call.
Margin call, yes.
Of course, below 3,000. So you have to bring it back to 4,000. So this is the drawback of trading with futures. If you are wrong on direction, you could potentially lose much more money than you have put in. Yes? You are seeing that, right? So you have to keep on putting money if you are wrong on direction. So that's something. So you better be right on direction when you are trading futures contracts. Okay. So now again, we bring the account back to 4,000. Now what happens? Gold actually goes up 892.30. We are making 530 into 2 into 100, 1,060 profit. So we have excess now. So excess money you can withdraw. When you have excess money more than the initial margin, it is assumed that you withdraw it back to your account. That's profit for you, you withdraw. Is that clear, students, how margin works? The same
Yes,
way
sir.
it works for stocks, indices, anything else. Yes.
Yes, sir. Yeah.
Yes, sir.
Any questions you guys have?
Sir, there's a term used, mark to market. So that is like, I mean, bringing the, or you can say, if there are any gains or losses at the end of the day, it's marked to the market price, is it?
Yeah, so see, every day your margin balance is getting adjusted, correct?
Yeah.
Based on whether it is going up or down. That is marking to market. So basically, you have your portfolio. You don't keep it at historical cost. You are marking it to today's values.
Okay. Okay.
So that is called marking to market. So every day you are marking the portfolio to market.
Okay. So the margins are recalculated then in that case, right?
So
Or
margin balances are updated every day based on the price fluctuations.
Right. Right.
So marking to market is keeping the portfolio at today's market values, as opposed to keeping it at historical cost.
Okay. Okay. Yeah.
And because
Got
of that, you will have short term. So till you sell, you don't have a loss or profit, but you will have a short term, you will have a notional profit or loss, which you have not booked. So if you are having a gain in your account, it will be an unrealized gain. Okay. So unless you sell, it is an unrealized gain or loss.
Okay.
So
Okay.
mark to market will actually, marking the portfolio to market will actually tell you whether you have an unrealized gain or loss. So once you actually sell, that unrealized gain or loss becomes a realized gain or loss.
Okay. Okay.
Is that clear?
Yeah. Yeah. It's clear, sir. Thank you.
Any other questions, students? On anything else? Okay. Now, the reverse. What happens if we do the reverse and we sold? We went short gold. Okay, students. What happens if we went short gold instead of long? Short means what? You sell before you buy. So the reverse will happen. You will actually have profits, which you can withdraw in the first two scenarios. Yeah. And in the last case, you would have had a loss. Yeah. For which there would be a margin call and you have to put your money back in. So you could either go long or you can go short. But that, how do you decide whether to go long or short? That is by looking at the graph, etc. Are you following the logic if we go short?
Yes, sir. Yeah.
Just the reverse, basically. So this is something you have to understand, because when you trade futures contracts, you are always having margin requirements. And why do you have margin requirements? Because you can't let people trade just like that. If they'll make a loss and run away, right? So you need a margin requirement to ensure security of your transaction. So of late, if you look, SEBI has increased margins much higher now for all these derivative positions. Margins were a lot lesser before. Now they are very, very high. So basically to ensure that there is no counterparty risk, meaning somebody trades and runs away once they make a loss. That cannot happen. The problem now, the same concept is happening in these cryptocurrencies, right? People are losing money. Even people who make money can't withdraw their money. Why? Because the exchanges, like the NSE guarantees, they have a very big clearing development. But the Bitcoin exchanges, they are stuck, right? If suddenly many people sell and they are all asking for money at the same time, the exchanges don't seem to have a reserve of funds where they can pay, like the NSE, like the New York Stock Exchange. So this is counterparty risk is a very big problem. that normally the exchanges, the way the exchanges are guaranteeing, right? To ensure there is no counterparty risk. How can they guarantee? Only if they collect adequate margins, right? So sometimes when the market makes a big move and crashes 10 or 11% in a day, many brokerages cannot, customers cannot immediately come up with funds. So usually brokerages and the regulator ease margin requirements so that the investors can slowly pay back the funds. So this is something that can happen. I think particularly in the next few days, with the market being go on a downward trajectory, suddenly if it makes a 5 or 10% move, these kind of margin calls can get triggered. Yeah. So I suggest you guys watch this movie called The Margin Call. That is a very, very interesting movie. It talks about how sometimes when you positions are going against you, risk management. How do we manage? How do we sell when markets are going down? So, and manage risks. So it's a very interesting movie, Margin Call. Maybe I'll play a clip maybe later in the class, but there you go. Okay. So since futures are traded on an exchange, they are settled daily. Okay. Closing out a futures contract, meaning involves in you putting an offsetting trade. So if you are short, if you want to close, you have to buy it back and close it out in a long position. If you are long, you close out by selling it. Okay. And most contracts, usually futures contracts, are closed out before maturity. By the way, you guys know when the derivatives contracts expire in India?
Thursday.
Yeah, every Thursday you have weekly expiry, and the last Thursday of the month you have index expiry. Sorry, individual stock futures contracts expiry. So that in the weekly basis you can trade only index derivatives. You're aware of that, right? Stock derivatives are not available on weekly basis. By the way, you guys know which exchange is the largest now for derivatives transactions in the world?
No, sir. No idea.
NSE, our
Is-
exchange. Our exchange is the largest because of all the weekly expiry transaction. When the lockdown happened, there were a lot of people apparently trading derivatives, and now they are. Market went up, so it was easy for them to just buy and keep buying. Now, when the markets are going down, all those newbie traders who have come into the market the last 2 years are going to be finished. So I think that that is a warning sign, right? Anyway, let's see how the NSE continues. But I think trading weekly or derivatives is a very risky business. Yeah. But I think now I typically like to stick with the monthly ones because at least you have time. In derivatives, particularly in options, you need both time and direction. You have to be right on both. So it's a tricky thing. So just a second. Okay, students. All right. Now, what happens if futures contracts are not closed before maturity? Then whoever is owning that contract will have to take delivery. Yes. So if you are owning an index contract, it is cash settled. The exchange will settle. But what if you own something like a commodity like gold, you have to take delivery of that. You have to have the money, first of all, to buy all those contracts. You have to have a warehouse to take all the delivery, right? So to avoid that, people usually close futures contract before. However, there might be a company which is requiring gold, jewelry shop. So they will actually take delivery, okay? Take delivery of the underlying asset. Students, you've gained access to this, all of you. I sent you that link.
Yes, sir.
Okay. Now, there is something called contango and backwardation in the futures market, right? If the spot, so there is the underlying asset, which is the spot price, and then there is the futures price. If futures price is ahead of the spot price, yeah. If futures price is ahead of the spot price, the basis is usually cash price minus futures price. If futures price is ahead of the spot price, the market is referred to as a contango. Yeah. However, if futures price is below the cash price, the market is called backwardation. So when the market is in contango, people are expecting it to rise in the future usually. When the market is in backwardation, people are expecting prices to fall in the future. So this is something interesting to observe in the futures market. Is that clear, students? Do you understand what contango and backwardation mean?
Yes, sir.
Students, ask questions then and there. Do not wait till the end. You may forget. Okay. Now, open interest is the total number of contracts outstanding. Okay. So usually equals to the number of long or short positions. Yes. So open interest is a very important terminology. It is telling you how traders are positioned in the market. So if the price is rising and open interest is rising, that is a sign of a strong uptrend. However, if price is falling and open interest is rising, that is the indication of a strong downtrend. Okay, students. Settlement price. So every day at 3:30, we will get a price. That's the settlement price on the Indian exchanges for the stock and the index futures. Volume of trades, number of trades in a day. Then this happens every Thursday. What happens every Thursday? Spot and futures price at 3:30 converge. Yes, because the futures contract and spot converge on the last day of expiry. And that happens. So sometimes futures will be ahead of spot. So there is arbitrage opportunities possible. Arbitrage means buying futures, selling spot. If futures on Thursday, you see futures is 5 rupees ahead of spot. What can you do? You can buy spot, sell futures, and make that 5 rupees of riskless profit, because you know at 3:30 it's going to converge. Yes. Yeah. Okay. So regulation, SEBI is the regulator. Yeah. Just like stock market is regulated, the derivatives market is part of that. So that is overseen by SEBI as well. Okay, okay, this we don't want to worry about. Okay. So if you have a commodity and you want to calculate the futures price. Okay, before that, since we were talking about the market, I will see if there's an update. So Sensible, you must look at this channel, guys, because Sensible gives a very good market update for every day. Okay, so they look at the derivatives positioning, particularly the option derivatives and all that. And I don't know whether they have, let's see here. Okay. Let's look at the subscriptions here. Where is Sensible? This is a good channel, guys, if you want to get into derivatives. Daily they give you a market update. I don't know whether they did the so only 17th June he has done. But these guys were correctly anticipating the market move. Very smart guys they are. In fact, they offer some kind of subscription through most of your brokerages. But every day these guys put through a video. So have a look at this. I'll play Thursday's video and see how they position. Let me know if you hear the audio. If you don't, whatever.
The three simplest, most predictable asset classes which have multiple sources of data. We look at open interest, we look at charts, we look at FIDI data. We don't do anything fancy. We keep it very simple and stick to our simple analysis. Sometimes we're right, sometimes we're wrong, but we don't try to complicate things with 100 indicators and 200 moving averages. So idea is simple. We try to look at the technical setup of the market and try to have an informed opinion on what the market is likely to do tomorrow. More importantly, we focus more on if the market does this, we'll do that. If the market does that, we'll do this. We create some scenarios and we suggest some trade for each curveball that the market might throw in our way. Now, yesterday, this is what we had thought, that if 100 basis points come, market will have a big fall. If 75 basis come, market will eventually fall, right? So that eventually came with a lot of riders. So initially the market went up and eventually it fell, but I didn't think, I didn't expect a positive opening, at least yesterday. When we ended the program, I thought market will open flat and eventually fall down, but it just went up 100 points and fell down, which means brilliant for everybody who had a time to sell on the uptick, right? And our standard two things we said yesterday at the end of the market was, one is always sell on uptick, which we got a very nice uptick, 1% uptick or kya chahiye life mein, right? And the other thing which we said, of course, was don't buy even at the channel bottom, which was also kind of true because today it actually broke the channel bottom, right? So with all this in place, let's see what the market is likely to do tomorrow. So the first thing, like, I'll just hide the things which we have not reached. So the first and foremost thing you will notice here is that there is a huge bearish engulfing candle, proper bearish engulfing, right? There's a tiny candle here and there's a big candle here. This is the very definition of bearish engulfing. Again, it tried to break the trend line, but it could not, it did not sustain and it went down. So it looks like market, and it gave a false breakout. And it looks like there is a very high probability that the channel is history, right? The channel is most likely gone, is my read. So looks like the channel is gone. Now what the only hope is that maybe it will go up a little bit, test the bottom of the channel again before it eventually falls down is my read, right? I could be wrong, but at least from here, that's what it looks like. Now, because tomorrow is the weekly expiry, we'll also look at the weekly chart, right? And this is a big red candle. The only hopeful thing for Nifty for tomorrow is that there is a 100 weekly moving average here, which might or might not act as a support. Like, I mean, in Nifty, right, weekly moving averages are a little tough to play. For example, if you look at the past data, at all these points, Nifty 100 weekly moving averages have kind of acted as a support. But I mean, do I want to bet on a reversal just because there is a 100 weekly moving averages? I am not sure. And my other point is that here itna lamba ek channel chal raha hai. It did not break such a long running channel only to take support at the very next zone, right? If it broke something significant, it's not like the next thing it finds, it will take support there, right? Chances are that now that Nifty has put in so much effort and broken the 100 DMA, 100 WMA rather, it will continue its journey and break the 100 DMA, it looks like. But let's not predict. But I'm just saying that please don't long Nifty thinking that there is a 100 DMA here, 100 weekly moving averages here. This bottom catching bar reversal ka point predicting business is extremely harmful. Now, let me also look at the next one, right? Let's look at, one second. One second. Sorry. So let's, I have a massive cold. I'll just activate here. So now let's go to the next part, which is option chain data, right? So option chain data for tomorrow is very interesting. If you look at it, right, the most interesting part is that except for 15,000, there is no OI anywhere. Look at this, right? It's like a desert. There's nothing anywhere. Let me just turn off a couple of things. There is absolutely nothing which is suggesting any kind of a support, because if you look at 23rd June ka option chain, काफी खाली, right? Very little OI here and there. The first significant OI is 15,000, but you can see that 15,500 ke upar there is OI almost at every level, right? And 15,700 and all is massive OI. So that is the first observation. Also, although it is day one and it is insignificant, if you look at the PCR, it is 0.45, which is phenomenally low. So let's write both of that down. Now, interesting thing is that FII data has not come from the NSE boys, but let's just refresh and see if they have put it. No, FII data hasn't come. Only spot data has come. The future data hasn't come. Neither has the option data come. But spot data says that it's around 3,000 crores selling, right? Now, the overall verdict of this is a downtrending market, right? And selling on uptick is the way to go. My only, so this has, I've always been saying for the last God knows how many days, but the only thing I want to stress here is that please don't try to long the market because you might find a support. Long the market only if that support starts price action, rejection and reversal candles. So it's very tempting to think that yaar bottom of the channel hai, 50 WMA hai and all that, and maybe something will happen. But the truth is, today's candle was a bearish engulfing, which is extremely negative, and it is engulfing a doji at the bottom. Today it looks like it broke the channel. Today it looks like it could not sustain above the trend line. All of this is negative, and it broke such a long-term running channel. So aisa nahi, and it also broke these two horizontal levels which we have drawn in the past. Now Nifty did not break all these important levels just to come and take support at that WMA. I don't think so. It's a very unlikely possibility, right? So overall, I'll be very happy now to sell calls for the simple reason that OTM calls, high IV environment, you'll get a lot of theta decay and a lot of time value. Now let's go to Bank Nifty, right? We were saying this yesterday that Bank Nifty is not sustaining above the middle of the channel, and also we looked at this trend line which it could not break above. It tested it twice, got rejected twice. Today again it tried to break the trend line, and now this is the ultimate rejection, right? Now Bank Nifty for me is even more bearish than Nifty. Now my thought process is that if Bank Nifty is definitely going to fall, then it's highly unlikely that Nifty will rise. So Bank Nifty looks like it can go all the way to 30,000, which is the bottom of this channel. That means possibly another 8 or 9% correction. So Nifty IMHO, I think might fall because I don't see Bank Nifty rising. And if Bank Nifty is 40% of Nifty, ऐसा नहीं हो सकता कि Bank Nifty falls 8% and Nifty will rise, right? So purely driven by Bank Nifty, despite the 100 WMA, I think that because Nifty has formed a bearish engulfing, because the trend is negative, because there is FII selling story, because these two horizontal supply zones are broken, because the long-term channel is broken, etc., Nifty and Bank Nifty are both down. The only missing piece of the puzzle is USD-INR, because USD-INR seems to be flat, right? I mean, that is confusing for me. I expected USD-INR to go up today, but it actually was flat around, I think it fell around 7 paisa. Can't say fall, but it is flat. And today's spot close was around 78.05, and now it is trading under 78. So USD-INR is flat, which is slightly confusing, but otherwise the entire picture fits. Nifty looks weak, Bank Nifty looks weak, USD-INR staying in the range. I don't know why. I thought it had broken out, but it's still struggling in that tight range. So net I would say that the thing to do going ahead is Sarthak is saying that's not bearish engulfing. Yeah, why would you not say it's a bearish engulfing? Because I mean, ideally yes, a bearish engulfing should be formed at the top of a trend, but this is a small tiny doji and it is covering the doji, right? I mean, it is a Marubozu, of course, yes, because all engulfings are also Marubozus, but but I don't know why you would think it's not a bearish engulfing. So net, right? So it's kind of stupid to predict the targets, but I won't be very surprised if we see around 14,000 on Nifty, right? Simply because it has broken this level, and I think the first zone of consolidation which has happened in Nifty after this level is somewhere, but I'm not saying that short till then. I'm saying that look at tomorrow's price action. If tomorrow it forms a reversal candle, right? Let's say a bullish hammer or a bullish harami, or even a piercing is unlikely. A harami or a hammer I would pay attention to, and if it closes back into this channel, that is somewhere around 15,450 plus levels, right? So if Nifty closes below today's close, which is 15,380 types, then it is unlikely that we have any hope left in Nifty. But tomorrow, if it gives a reversal candle and it gives a close above 15,400 odd levels, then maybe there is hope, right? But a Nifty which is closing below today's close of 15,370-80 odd levels means that it is confirming this bearish engulfing, and there will be continued selling, and we don't know where the selling will last till, but it can last quite a bit, right? So that is the scene of Nifty. Now Bank Nifty levels are, if it is going to stay below 33,000, then it is always going to be bearish because it is the middle of the channel zone. So Bank Nifty, I would expect it to correct all the way. So if tomorrow happens to be close below today's close, then it has confirmed the bullish engulfing, and we are going to potentially see a move all the way to 30,000. USD-INR, it's genuinely confusing. I don't know which two forces are at play, right? So that is our analysis for today. We will see you again tomorrow. I hope this week went well for everybody. So yeah, that's that. So I will see you again on Sunday with next week's analysis. So I hope this expiry and today and all these days went very well for you.
Okay, students. So what are your takeaways from that? You would have heard the audio quite well, right?
Yes, the audio was clear, but I mean, video was a little blurred out.
Not very clear, yeah.
Yeah.
So what are your takeaways from that? Some clear things you were saying. So this was Thursday's video, okay. He has not summarized Friday's market action, but in that he has clearly said something. What was his take? Did you guys see that?
So his take was Nifty and I mean Nifty going down. That is the bearish take because yeah.
Very true. So one of the things he did say was, if price closes below Thursday's low, okay, yeah. So if price were to close below Thursday's low, then the bearish trend is most likely continuing, right? That's something he mentioned, right? And price, what happened yesterday's price action, if you recollect? It did close below Thursday's low, right?
Yeah, yes, sir.
So that is confirming the bearish action that he is talking about. So you should analyze the market from n number of different ways before you decide, right? So sometimes we all feel that the market will do something and we go for it, right? But it may not be the best way to do it, because the market can go in a completely different point. So that is why I listen to as many different opinions before I make mine. But I think I didn't see too many opinions that said buy the market today. So hence little cautious to say this. But do watch this video if you want to get some good input, because these guys are very smart. Sensible is a very interesting option add-on package that is being offered. This guy is the owner of that Sensible a bit, so he's very knowledgeable, and his take on the market has been spot on. He's been short the market since 16.9. In fact, 16.9 was what we talked about also. Last Saturday, market had closed at 16.9, near there about 16.8 levels, and I was showing you the Bollinger and saying the MACD was going to cross and it's going to give a crash, and it gave a really big crash. So analyze the market from all possible directions before you make a decision. I typically do a lot of analysis on the weekends, and I think thankfully we have your class now. So I normally do it over the weekend. So by Friday, I do my analysis now, so I can share it with you guys in class. So yes, so I think independently coming up with your own analysis and system is very, very important if you are looking at short-term market movement, because short-term very difficult to make money unless you take into account all the different possibilities. On top of this, there is something called market geometry and astro stuff and all that. So there's a thought process emerging that markets usually bottom after the full moon and top right after the new moon. So some logic, twisted logic is there. I just watch that, but I don't pay much attention to that. That's another element. So crazy, yeah. Okay, so much there. So that's the market for you. So short-term looking definitely on the downside. I think there is downside. So he what was his downside target? Anybody remember from the video? Yes, any of you picked up his downside target on the Nifty? I think he said 14,000, if I am correct. Is that right? Yeah. So my downside target is somewhere near that. I'm thinking 14.5 because that's where weekly support comes in. Okay, students. So any questions on anything discussed in class before I move on to the next topic?
No, sir, no questions.
Okay, thank you. Okay, now how do we calculate futures prices? If you are a commodity, if you are calculating commodity price, futures on a commodity. So basically, what you are going to do is you're going to add the cash price with the interest cost required to keep it somewhere. Yeah, till the time of expiry, underlying commodity. And then the storage cost, the cost of putting it in a warehouse somewhere. If you add all these things, basically you will get your futures price. So interest cost is essentially your risk-free rate. Risk-free rate is, you guys know what the risk-free rate is?
Yeah, for India, it's government securities.
Yeah, so the 1 year return on government bonds is typically taken as the risk-free rate. And right now, where can I find that? Any of you?
RBI website.
Correct, very
can
good.
find it.
This is still loading, so I cannot show this much to you. So RBI, Reserve Bank of India. So if I click market trends here, you can see the 364-day T-bill, right? All the way at the bottom. So that's
Yes,
the risk-free rate, 6.28. About 2 months back, this was near 5.5%. So you can see how rates have gone up because of inflationary pressures. Yeah. So you can see how so 5-year interest rates, where's the 5-year interest rate? That should expire 2027. That we don't have for some reason. 1-year interest rate 6.46. 364-day T-bill is considered as the risk-free rate. So there you go. 6.28. Yes. That's the risk-free rate today. Okay. Okay, so have a look at this example. Now, so you're given that on November 9, 2004, the cash price of gold was 6,105. The November futures contract was quoted at 663. Assuming a risk-free rate of 10.5% and storage cost of 409, what is the price of the futures? So we'll use that above formula, calculate, and see if there are any arbitrage possibilities. So apply the formula, students, and see what value you get on the futures price. Give you 2 minutes. What value you get, students? Have you any of you run the calculation?
Just a minute, sir.
Yeah, go ahead. Go ahead. Yeah.
So it's coming out to be approximately 7,155.
Have a look at this. Remember, you have to calculate the cost for 2 months only.
Okay, yes.
So I think you may have taken the whole thing.
Annual, yeah. Yeah, yes, sir.
Is that coming?
Yeah.
So the futures price is 6621 and actual November gold is 6631. So, so what can you do? You can buy the spot at 6633 and pocket 12 rupees by selling the futures. So the arbitrage opportunity is there for you to take because futures and spot price are different. Are you understanding that, students?
Yes, sir. Yeah.
So the theoretical futures price is coming at only 6621, right? So you can actually buy the spot and sell the futures and pocket 12 bucks. Any questions, students, on that?
No, sir. No.
Okay. Okay, then. Now, how do you value a Nifty contract? So, so if Nifty spot, same logic you can use, but here in Nifty, there won't be any storage cost, right? It's a stock index. So that won't be there. You'll still have the interest cost from the risk-free rate, assuming you buy and hold Nifty. So that will be there, but there's something missing here. So if you apply Nifty contract and futures price, you will always get, you'll get something like this. Okay, same logic as before, no storage cost. But in this case, we assume that Nifty doesn't pay dividends, but in real life, Nifty will pay dividends. So if companies are paying dividends, how do you account for that? Okay, so many companies on the Nifty pay dividends. So how do you account for that? So for that, this formula is used. So we incorporate dividends, we discount the dividends, find the present value of dividends. Yes. And basically use this formula. You can have a look at it. S minus I into e power RT is how we calculate the future price of stock. Because in the previous example, it was too simplistic. We didn't account for dividends. So if dividends are paid, how do we do that? So I is the present value of dividend paid, and I is calculated as D into e power minus RT, where D is the dividend paid today or dividend paid. Dividend paid a year from now, which we are discounting and finding the present value of today. All right, students. So if dividends are involved, which is really the case, then you can value the futures contract. So we will look at an example. Have a look at this example. Now, one more thing we have to do is R, which is your risk-free rate, has to be in futures calculations. We will find something called the continuously compounded risk-free rate, which is ln 1 plus risk-free rate. So what is the continuously compounded risk-free rate? We assume that everything is reinvested, right? So before you apply any futures formula, you cannot directly use the risk-free rate as such. We can calculate the continuously compounded risk-free rate. So for futures contracts, so have an example. Here's an example. Remember, we are discounting future dividends today, and then we are finding the continuously compounded risk-free rate, and then using that to calculate the value of the futures contract. So when they quote Nifty futures and you're seeing it slightly ahead of the spot, this is the reason. Usually the problem with this calculation though, it will only say that the Nifty will always be in contango, or futures price will always come ahead of the spot price. Logically, that should be the case, but there can be instances when the market futures prices below the spot price, or it can be recently futures price was below the spot price on Nifty. So this formula, that is the drawback of this, is that it will always say futures is ahead of the spot price because it works on continuously compounding and discounting dividends and projecting future value. So that's the problem. So just that example, applying that formula then. So first we can convert R to the continuously compounded risk-free rate. Then we discount the dividends, I equals D power E power minus RT. Then yes, so you can just pay attention to this. So I'm of course this, you must just know, and the reason I'm showing you this is you have to understand how actually these future contracts are calculated. No need to worry about memorizing formulas and stuff, because we are not going to assess you guys on that. We are going to assess you on live market stuff. So, but anyway, you must know the background. So this is how it is calculated. So what do? We convert the risk-free rate to the continuous compounder. ln is natural logarithm. You all know ln, right? Logarithm to
Yes,
the
sir.
base e. Yeah.
Yes, sir.
Yeah. So that's how we calculate that. So we calculate E, and then once we calculate R continuously compounded, we use that to calculate I. Then once we calculate I, we plug it to the formula S minus I E per RT and find the value of the futures contract. So here you should note 25 days. If it is days, we divide by 360. Some people say divide by 365 also. So 360 is good enough because there are many holidays in between. And Saturday, Sunday, usually the exchanges don't trade. So 360 itself is good enough, many people say. Time should be annual in years. So if you have days, you divide by 360. If you have months, you divide by 12. Is that clear, students?
Sir, I have a doubt. So,
Yeah.
so we take here the expected dividends, right? For future
Yeah.
expected dividends,
Yeah.
right?
Yeah.
But since we don't have the exact data available, so is it on the basis of the growth rate for that particular, contract which we're taking? I mean, how is it the?
So how do you know that the dividend is going to be 1280 in 25 days? Is what you're asking, right?
Yeah.
So that is basically from analyst projections.
Okay.
So these analysts will look at historical dividends and say that is only an expected, it won't be accurate.
Mm-hmm. Yeah.
So if suddenly the economy goes south in the next 25 days, you may not get a dividend, right?
Right.
Yeah, so it is just an estimate.
Okay. Yeah. Thank you.
Yeah. So any other questions, students? So For I, you use the 25, but when you are using F, which is the futures contract, you're using the 2 months based on the expiry. Yes. Is that clear, students? Yeah.
Yes, sir.
Okay. Any other questions you have on anything discussed so far? Okay then. Okay. Now we come to forward contract, which is very similar, but only thing is it is over the counter agreement. Yes. You don't have daily settlement because it is not an exchange guaranteed contract. It is an over the counter instrument done between two parties. So at the end of the thing, the party can take delivery or they can close the forward contract before maturity if both parties agree. Okay, very similar to how you value a forward futures contract. Very, very, very similar, just like you had S minus I e power RT. Very, very similar. And you calculate the current forward price from the asset price. So forward contracts are very popular even now because many times you will see that wide range of forward contracts are available on exchange rate and interest rate products, right? As opposed to the futures contract. We for a long time, we did not have futures on currencies. Only recently, the last 10 years or so, that has come about. So forward contracts are very possible. Even though there is counterparty risk, right? Exchange is not guaranteeing them. So there is counterparty risk. And in fact, there was a scam on one of these exchanges because of this. There was an NSCL scam. Where it was a spot exchange, which was doing forward contracts on commodities. And some people wanted to take delivery and the exchange, there was an exchange called the NSEL, spot exchange. And ultimately had to shut down because they didn't have the underlying asset. Some people bought a gold futures forward contract thinking they'll get gold. They want to take delivery. But at the time of delivery, these guys did not have the money to, did not have the underlying asset with them. They are supposed to keep, the exchanges are supposed to have the asset and facilitate delivery, but these guys didn't. Okay. So counterparty risk is something that is present in a forward contract. Okay, so same concept. Let's look at the short forward contract. So in short forward, it will be the other way around. F naught minus K, here it will be K minus F naught. Short is because you sold it. Other logic remains the same. So here is a case where a non-dividend paying stock is taken in. Yeah. And we are looking at finding the value of the forward contract. So we will first calculate, right, S naught, F naught, and then use the appropriate form. So this is how forward. So forward contracts today are not available on stocks on the Indian exchanges. They are only available usually on rupee, interest rates, etc. Yeah, in the stock market, you have only futures contracts. Okay, forwards are not there on stocks, but you can technically create them. Yes, but the problem is if you create forwards on stocks, is it a good idea, you think? What do you think? Should we allow forwards on stocks? What do you think, students? Yeah, so I don't think it's a good idea. Well, the reason is counterparty risks. See, you will buy a forward contract, you only have to settle at the time of maturity, right? So expiry. So expiry, let's say, is last Thursday, or not even, you have some idea. You can even have, because it's a private contract, you can even say, I will take a forward and we will settle it 5 months from now. But what happens, you bought a forward and the price went down, and now you have to come up with all this money to do settlement. The one party may disappear, right? So counterparty risk, meaning that stock market can be exposed to counterparty risk, and that is a very dangerous thing. So hence, futures are the way to go because they are guaranteed by the exchange like NSE. Right? You already just now have seen what is happening in the cryptocurrency market, where nobody is guaranteeing anything. So counterparty risk is something that can destabilize the financial system as a whole. So hence, forwards on stocks and indices is not a good idea. Is that clear, students? Yes?
Yes, sir.
No? Yeah. Okay, so how do we profit from a long forward or futures position? So to profit from a long forward or futures position, your underlying asset has to rise. If it falls, you make a loss. If it goes up, you make a profit, as we saw in that margin call example. Right? You make a profit when the underlying asset rise if you are long. If you're short, you make a profit when the underlying asset price falls. Okay. So that's the thing. So in the previous case, long forward, profit, price goes up. Short forward of futures, you profit if your price goes down. Okay, so the difference. So some essential salient differences between forward contracts and futures contracts. So forward contracts are private contracts between two individuals, not guaranteed by exchange, right? They traded on, futures are guaranteed and traded on exchange. Forward can be customized, futures are standardized. Forward, usually one delivery date. Futures, you're gonna have many delivery dates. Yeah. Forward is settled at the end of the contract. Futures, daily settled by exchange. Usually, forward contracts delivery can happen. Here, usually in futures contracts, people usually close them before maturity. Some kind of credit risk is there because of counterparty risk. Whereas in futures, because the exchange guarantees everything, they collect adequate margins beforehand, there's virtually no credit risk. So in few forwards, there are not that high margins required to create these contracts. And as a result, counterparty risk is present. Any questions, students? So I was telling you about this counterparty risk and the NSCL scam. So let us see if we can find that. So this is a case study in this scam was different. NSDL spot exchange. There was another scam on the co-location, but that is not what you're talking.
You know, there are just some things you can't say on television. If you suspect that your advisor is not telling you the whole story, or there's something
Well, hello and welcome to Commodity Champions. I'm Anisha Gupta, and the SEBI orders this week barred 5 broking firms from dealing in commodities, declaring them as not fit and proper. Among these are Motilal Oswal, IFL, Anand Rathi, Geofin and Philips Commodities India. The regulator has an ongoing investigation against another 295 firms on similar charges in the NSCL case. More than 90% of contracts on the NSCL were paired contracts, and all 300 brokers traded on that exchange issued paired contracts to their clients. In the normal course, this order should have created chaos and rattled the commodity derivatives market, its volumes or participation, but that clearly hasn't been the case. SEBI, which took over the regulation of the commodity market from the Forward Market Commission after the scam in NSCL came to light, allowed the broking activities in equities and commodity derivatives to be integrated into one entity in 2017 by amending the securities contract regulation rules. Many of the commodity brokers applied for membership for dealing in commodity derivatives through their parent arm, dealing in equity and equity derivatives. All the 5 brokers have a huge active client list, and SEBI has specifically only barred the commodity broking entities that trading on NSCL and has not touched their promoters, parent companies, etc. Joining us to talk more about that now is Rajesh Baheti. He's President, Association of National Exchanges Members of India. Rajesh, hi, thank you so much for taking time out. It clearly has been a busy week as we've been trying to talk to all the stakeholders in the industry on what these orders mean. Is it too delayed? Is it too weak? Is it in the right direction? What really has been your initial sense?
Well, and at ANMI, we believe that these orders are not proper because A, the brokers did not have the kind of role to play in that entire scam as is made out to be. What happened is that you must understand that the exchange per se was legal. All it was not governed by FMC and SEBI at that time. But the exchange was definitely legal. It was set up under the Consumer Affairs Ministry. Sharad Pawar was looking after it.
Right.
And the entire exchange was legally set up. It had great parentage coming out of FTIL, who promoted MCX and MCX SX. And some of the contracts, so it turns out that this exchange launched turned out to be illegal. Now, just for a moment, understand, I'm a broker. I become a member of an exchange where, you know, all the clearing banks have participated. You had the likes of SBI and other PSU banks and private sector banks participating. It was so-called promoted by NAFED, and MMTC had a role to play in it. So here is an exchange which appears completely legal. It is legal. It launches few contracts, of which some of them turn out to be illegal. Now, me as a broker, am I supposed to check? The question number one, am I supposed to check?
I'm assuming yes, you have to check.
I have to check whether every contract issued by an exchange is legal or illegal. I mean, have you checked that everything that the NSE does or every contract that the NSE has launched or the BSE has ever launched has been legal?
Rajesh, during this week, we've actually tried and spoken to all stakeholders, whether it is the broking companies themselves, whether it is the investors, whether it is the exchange promoter itself. And we do understand that the kind of situation that we stand right now is everybody seems to be, putting a finger to each other is the kind of situation that is there. But does it really seem to be solving the crisis? Are the monies still coming? Where are we when it comes to the concern, the major problem really?
Yeah, so let's understand one thing. The charge that you levy on somebody should be independent of what has happened. Now, I'm just asking you for a moment, if all these monies were paid out, if there were no bad debts, if this exchange had not blown up, but had just shut this contract and everybody had received their money, would any of these charges have ever been made? I think the answer you and I know both well, the answer is no, nothing of this would have happened, no charges would have been made. These charges have only been made because something terrible has happened in that exchange as a default to the tune of 5,600 odd crores. But who has defaulted and who has perpetrated the default? The defaulters are the 24 members who were allowed to carelessly borrow money without depositing the requisite commodities, underlying commodities into the warehouses that were governed by the exchange. That was supposed to have been the exchange function of making sure that the underlying commodities are in place. So the perpetrators are clearly the exchange, its management, its parent companies, and the borrowers. Now, by shifting the entire lens onto the brokers that acted as agents
Or
merely to
facilitators.
facilitate the trades is really shooting the messenger, I would say. I'll just give you a small example. Unitech, the promoters are in jail for having sold n number of houses never delivered. I'm sure they were all sold through real estate agents. So are those real estate agents to be blamed for selling those products promoted by Unitech which never got made or delivered?
But Rajesh, the question still arises with everybody shifting blame to the next person. This is like a never-ending vicious cycle that we seem to be entering in.
Unfortunately, the focus should always and only have been to first recover all the monies. Now you've got to go after the properties of the borrowers. You've got to look at what is the benefit that the NSCL management and its parent derived out of the profits of.
Have you ever thought how a simple tool like Microsoft Excel powers entire businesses, right from human resource planning
Of this exchange, and then go after these entities? What have the brokers done? They've just acted as agents to sell a product that appeared extremely legitimate when it was on the NSCL. And let's not understand, this was not an underground operation that the NSCL undertook. It was all over the websites. It was a declared contract. Everybody knew about that this was going on. It took 2 to 3 years for the ministry and the FMC itself to correspond between each other to even figure out whether they should be allowing this or not. So it was not as if this was some underground chit fund that was operating and the brokers took part in it.
So Rajesh, since we have you with us, where would you say the checks and balances is something that everybody seems to have missed on the line, whether it is the exchange or whether it is the brokers or the investors, clients who actually traded on the platform via these brokers?
So I'm not saying for a moment that the brokers have not made a mistake. Sure, they made an error in judgment, but it's a judgment error. So Satyam scam took place, and at 11 a.m. Ramalinga Raju wrote a letter to the exchanges that I have nothing in my bank balances. I'm sure at the very moment there may have been 20 or 50 buy reports coming out of brokerages. So everybody acts in good faith. When you see the numbers on the ground, you act in good faith. NACL was the counter guarantor for all the trades. NACL said we have some requisite SGF. NACL was operating like any other exchange, except for the fact that they were not governed under the FMC. Now, why they were not governed under the FMC should be asked to the government of that day. So honestly, if somebody paints a picture that looks as good as any other picture that you've been dealing with, and you get fooled, it's just a bad
I get
incident.
that, but tell me, where do the investors go now? Because they will go to the people they can see or point finger at. So it is the brokers, it is the exchange, it is the promoters, etc. They need their money back, and until I think that happens, this backlash, this whole the grieving situation, or the investors who keep coming out with the kind of language and with the kind of concerns that is there will just about continue. So where do we stand right now? Where do we go from here apart from this?
See, if I was an investor, yeah, I would try my luck with everybody concerned. So maybe the borrowers first. If I can't get any breakthrough, I'll go to the exchange. If I can't get any breakthrough, then I'll look at my brokers because they're apparently still in business. And unfortunately, this is what is happening. But the fact remains that the borrowers' assets, and we still get to hear every day that over 6,000 crores of assets have been frozen. I fail to understand, why are they not getting liquidated? Why does it take so much time for this to come to some conclusion? Look at the Bernie Madoff scam. In 6 months he was in jail. Whatever had to happen happened. Why are none of these borrowers in jail? What's happening? So really the focus should have been on the borrowers. Unfortunately, some people have convinced some other people to take the focus off the borrowers and take it to the intermediaries.
So what are you hearing on ground now, and what are the procedures? Because this is a question I've actually been asking all the stakeholders on. Where do we stand right now? What is lacking? If everybody is cooperating with the authorities, why is the thing not getting pushed? That, of course, is my one question, Rajesh. The other is the SEBI order that only has barred an arm, and we do understand from the brokers that the business is as usual, because after the unified license, almost everything seems to have shifted to the securities or the parent arm. Does the order really mean anything at all then?
Per se, in terms of losing business, no. But after all, this is a reputational black mark. And none of these guys would want a reputational black mark to, you know, soil their reputation forever. Because every time they go to a bank for facilities, or every time they approach somebody, this is going to be part of their history. So everybody would like to get this off. And I'm sure they will appeal, even though in monetary terms, it means nothing because none of these companies were active. But the fact remains that why has SEBI only barred these arms? I think somewhere deep inside, even SEBI understands that really these people were just agents got taken in by this whole idea that was built by this exchange. And unfortunately, they had also to be seen to take some action. So they are saying, okay, we'll take this limited action. But if you ever raise the larger point, I would raise the same point. If the guy is not good enough to do this, why is he good enough to do that? Which is exactly the same thing, except in a different company.
So brokers also have had their monies on the exchange, as was the case with the clients also. So again, this is a question I keep pushing yet again. So what happens from now? When do we actually see the monies being disbursed? I think that would really put an end to the matter.
All of us are saying exactly the same thing. Go after the borrowers, go after the money, go after those assets. First, let's get the money back as much as we can. I'm sure if they try hard enough, they can get, a good chunk of this money. Now, there are various cases pending in various courts. I think the focus of all the authorities should be on nailing those assets, to get those assets auctioned, to, even that merger issue is pending in the Supreme Court. I think we all need to push for faster judgments on all those cases so we can at least get the chunk of the money back. Brokers themselves have 1,000 crores of proprietary money stuck in this. So honestly speaking, if the brokers were trying to push a product they knew was A, risky, and B, illegal, why would anybody put their own money in this?
One final word from you, Rajesh, before we thank you. What is your sense on this whole thing? Because the way it has been, we saw the settlement problem come in 2012. We are in 2019 right now. What would you say about the kind of progress that has been made, let's say, for the last 5 to 6 years?
See, I mean, in some respects, I think the entire judiciary, the whole system in our country does not deliver justice on time. We've seen Harshad Mehta judgments coming in 2018 and 19. I mean, this is really unfortunate. Some of the Ketan Parekh cases are still going on. So really, I think we've got to move and maybe create some special courts, some tribunals that handle such kind of cases which are more technical in nature than, your regular cases, and get these sorted out. We need to set a time limit of 365 to 700 days, a year or two, just like the IBC code has a target. Once we have that target, two things will happen. A, people will not defraud the world so often because everybody gets away with it, and that's what they think. And B, we'll get the investors who even lose their money likely to get some recovery really quickly.
Well, that point is taken well, Rajesh. Thank you so much for joining us. Well, that's yet another view.
Sorry, I was talking and I was on mute all this time. So, sorry, to give you a background, this NSEL spot exchange was actually, the promoters were the same as the guys who had promoted MCX and other exchanges. They had all these good backgrounds. But what they did was a classic scam, almost 5,600 crores. So they basically issued forward contracts. Remember, forward contracts have an associated delivery with them. At the end of the forward contract, whoever has bought a forward contract can choose to take delivery. So the exchange, when they issue a forward contract, they should have the underlying asset with them. So in this case, gold, silver forward contracts were issued. But the spot exchange basically did not have the underlying assets with them collateral. So they were basically creating fraudulent contracts, saying that the asset will be delivered, but not having the asset with them delivered. So the problem was these guys were regulated by someone called the Forward Market Commission, who are basically government bureaucrats sitting and not knowing anything about what's going on. So once this happened and underlying asset was not available, people said, let's go find if any of these underlying assets are in warehouses. Nothing was there. So basically the forward contracts issued and purchased did not have any value. So this was a very big scam. And ultimately the Forward Market Commission, they removed this exchange. They had to close it down and wind it up and try to settle. And ultimately it was a case of many brokers promoted these contracts, but they themselves probably didn't understand what was going on, because it's a case of counterparty risk. This could never have happened if it was an exchange where daily settlement took place. And obviously you would know, right? So case of counterparty risk. So every now and then when there is counterparty, imagine if this happened with commodities, what happens if you allow forward contracts on stocks? Any number of scams can happen, right? So hence this is the counterparty risk element in forward contracts. Similar such risk happened in 2008 in the subprime crisis, where it was a question of not forward contracts, but credit default swaps. Those are also over-the-counter instruments, and they caused almost the entire financial system to collapse. So if you are issuing products that have counterparty risk and you do not quantify the risk and you're not aware of it, then trouble can happen. Okay, so you must be aware that it's better you enter into transactions on exchanges. So again, this cryptocurrency, many thought they were valid exchanges. Now, when you're going to sell, you're not getting your money. So what kind of exchanges are they if they're not guaranteed that? So this is again another problem. So counterparty risk happens time and time, particularly when there is stress in the financial system. And you will see more and more cases of cryptocurrencies blowing up. Yes. So I would stay away from that space. It feels like it's a rigged system out there. Okay, students, any questions on this?
No, sir.
Okay. Were you aware that something like this happened in India, NSEL spot scam? Happened about, yeah?
Yeah, just heard an outline of it. I'm not aware of the details, technicalities.
Yeah. So this was a very big scam that happened. So one of the person who was being interviewed there, he made this point, right? That scams should be immediately tried and brought to justice. So imagine this, 30 years after the Harshad Mehta scams happened, still the judgment is being passed. That means, so the reason is many politicians get involved in these scams. So, and ultimately that delays everything and public lose their money. So counterparty risk example there, right there, happened in India. So now SEBI is regulating all the exchanges, so, and they are better at it. Not to say that another scam may not happen, because under SEBI's watch, Satyam scam happened, right? So, okay.
So MCX and NCDX, those commodity markets, they're being regulated by SEBI at the moment, right?
Yes, they are now. Yeah, they are. They were also, but this NSEL spot exchange scam, NSEL was a spot exchange, but they were not regulated by SEBI at that time. They were regulated by the Forward Market Commission, who did not keep a good eye on what was going on. So now, if there was another exchange, it will come under SEBI. So that thing. So because nobody was checking what was going on, and I'm sure these guys perpetrated a scam. Okay, students. Before I go to the next topic, so are you guys happy with how the class is going on? Do you want anything else? You want something less? You want something more? If you want something more different, you can speak up. Yes? Yes, students?
Yes, sir. Yeah, I'm happy with the way the flow is for the class. Yeah.
Okay, so I'm just trying to mix the basics with the every now and then giving you appropriate examples so that element works well. And I will try and relate the market always to our discussions, because at the end of the day, knowing about derivatives and not knowing how to make money is a very bad thing. So we'll continue on that trend. And if there's anything else you guys want to know, you let me know. We'll cover that. In case I missed something or something, we can cover that. That's not an issue. Okay. Now, futures contracts on interest rates are also important. Remember, this is a time when interest rates are going up. So what happens if somebody wants to protect themselves from interest rates going up? So they can sell bond futures and protect themselves against interest rate hikes. So bond futures contracts have emerged in the last 10 years or so. In 2014 was when bond futures started trading, and T-bill futures are basically calculated very simply. I mean, there's not any big formula, just the discount yield you subtract from 100 and you can get the T-bill futures price. So if you know the effective yield of a T-bill at 5%, then 100 minus 5, that should be the price of the T-bill future. So T-bills and T-bonds are something that have started trading now. You can trade futures contracts and they offer good hedging vehicles. So typically, why should we, you guys, I saw you guys do some fantastic assignments on bond duration and stuff, right? Kiran Bindu sir had made you do some great assignments. I've seen your spreadsheets and all that. You guys know duration and all that, right?
Yes, sir. Yeah.
You understand the concept. So basically, right now, yeah, what do I need to be doing? If I own a bond portfolio, what must I be doing now? I must be trying to reduce interest rate risk, right? Yeah, because interest rates are going up, right? Even if interest rates go up, my bond portfolio is going to go down, right? So I want to try and lower the duration of my portfolio, right? So one of the ways to hedge against interest rate risk is by selling T. Yeah, so that assuming that government bonds are also going up, right? So sometimes corporate bonds may go down in price and interest rates may rise there, but government bonds may not. So that also you must be aware. But now is the time when government RBI is raising rates. So yields on government bonds are going up. So you have to hedge that. So how do you, just curious, how do you reduce the duration of a portfolio from what you guys studied last summer? Yes. Yes, students, how do you reduce the duration?
More amount of interest or return-based bonds. They'll increase the YTM, yield to maturity, and that can decrease the duration.
So basically, if you can get bonds of high coupons but shorter maturity, that can act as a cushion against interest rate risk, right? Shorter maturity, higher coupon paying bonds, that you can do. Other thing you can do is you can find zero coupon bonds which are equal to the duration of the portfolio. So zero coupon bonds don't have interest rate risk, right? But unfortunately, if you have one thing, you can't have the other. Zero coupon bonds have reinvestment risk. Interest rate risk they may not have, but there is reinvestment risk because you have to reinvest all those things at maturity. Once the zero coupon bond matures and you get the full amount, if interest rates change, then you have reinvestment risk. So anyway, so duration is something you have to reduce. So hedging bond portfolios you can do by selling T-bonds as a hedge. Okay, so that's what it is. Recently, currency futures are also started to trade on the exchange. So USD INR futures, INR based contracts are now traded on the NSE. And MCX also, I believe, has currency futures trading. So rupee futures have started trading. So now that is a good thing for exporters and importers to hedge their risk. So futures rate is given by this concept: spot rate into 1 plus interest on home currency into the time period divided by 1 plus interest on the foreign currency into time period. So this is how a currency futures contract is calculated. So example here. So how do I find my USD INR futures interest if I were to have all this data with me, right? So you can apply the formula and kind of find out what the futures contract price is. Very simple formula, nothing big. So you can just directly apply that formula and find out what the rupee futures is. Yeah, from the spot rate. So what type of market is this, students? Is this contango or backwardation?
So this is contango.
Yeah, very true. So futures is ahead of the spot. So futures price is 46.76. Spot price is 46.35. So rupee futures market is ahead of the spot. So it is contango. Excellent. Good. Okay. So one of the things about futures contracts that it comes in very handy is that they can be used as good hedging vehicles, right? So if I want to hedge my exposure, I own a portfolio. Classic case, last 2 weeks, I own a portfolio, but I think it's going down in the short run, maybe 1-2 years. So what can you do? You can sell some futures against it. So your loss in the portfolio will be offset by your gain in your futures position. Okay. If you sold futures, as the market comes down, your portfolio may lose value, but your futures contracts will gain value and offset the loss. Yes. So that's something you could have done. Okay. Okay. So you can have long and short futures hedges. So a long futures hedge, when is that relevant? A long futures hedge is appropriate when you think you have a short position, then you have a long futures hedge. If you have a long position, you need to have a short futures hedge, right? So if you have a short position, you took something, you're betting something goes down, but you think in the short run it may go up, then you can buy a long futures contract on it and hedge. On the other hand, if you have a short futures hedge, let's say you have a portfolio now, you think it's going down in the short run, you want a futures hedge against it, there you go. Short futures hedge is relevant. So you sell futures and hedge. Okay, the main argument for hedging, say suppose you are Infosys. So Infosys is, right, exporter of IT services. So what happens? What is Infosys's biggest concern? They do their business, everything works fine. But when they are bringing their money to India, they want to get maximum rupees for their dollars, right? Is that right? So Infosys is going to be concerned by what?
Exchange rate fluctuations.
Correct. Exchange rate, particularly what? Rupee going up in value or down in value? So if the rupee strengthens, Infosys is going to get less rupees for their dollar, right?
Mm-hmm.
Is that right?
Yeah.
So Infosys is worried about strong rupee. So what will Infosys do? They will hedge, right? They will hedge the rupee dollar exchange rate. So Infosys is worried about strong rupee, if the rupee strengthens. So right now Infosys is happy because the rupee has been weak. But if suddenly the rupee starts to strengthen, then their profits will get eroded, not because of their business, but because of the exchange rate. So to control that, to not worry about the exchange rate impact, they will hedge exchange rates. Is that clear? So the argument for hedging is you should do your business and not worry about exchange rate. Okay. So many of the top IT firms usually hedge exchange rate exposure. Of late, it has been good, right? The last 75 years since independence, rupee has gone from what to what? Students, rupee has gone from what value to what value? What was the rupee at exchange at independence? Anyone? Any guesses?
Sir, are you asking about USD INR rate?
Yes. USD INR exchange rate. Yeah,
Sir,
sorry.
Rate is somewhere around 78. That is the highest in the entire record.
Yeah, right now. Yeah. But what was it during independence? Any of you remember? You guys were not born. Even I was not born. But any guesses?
Maybe between 5 to 10. I'm not sure, but
It was one. 1 rupee was worth $1. Now look at it. 78, right? So the IT companies have made a lot of money and they've got a lot of money when they brought their dollars back because the rupee has been weak. But my goodness, 75 years it has non-stop gone on. So there is a chance, right? For a 10-year period, it may strengthen, right? Possible? It can. So in that case, what will happen? Their profits will get affected. So that is the case for hedging, right? So you have to hedge and control factors that are beyond you. You can control what's going on in your business, but you cannot control what's happening in the exchange rate. So people say you have to hedge. Is that clear? Now, what about for importers? That's the other way around. They are worried about weakening rupee because what? They will have to pay more for their imports, right? If the rupee weakens. Yeah, so that's the other way around. So for them, it has not been a good last 75 years, right? So the rupee has been very weak, and importers, if they don't hedge, some of them may have gotten wiped out on because they cannot afford any raw materials or anything else they import because the exchange rate is moving against them, right? So this is why you have to protect yourself against exchange rate fluctuation, and that is called hedging. So some arguments are there against hedging also. So sometimes if you hedge and it doesn't work out, you still pay for the hedge and you have to justify to shareholders why you did it. But that's not a big argument. I mean, ultimately you cannot control what's outside. So most of the currency big for IT firms have a good forex hedging department. So has everybody else. The other thing people do was in interest rates in places like Japan, very low. Only now they started going up, but they were below zero in Japan and Switzerland and all that. So taking foreign currency loans was an attractive thing. But when you take a foreign currency loan, what must you be careful about? the exchange rate, right? Suddenly, if your local exchange rate collapse, you have to pay more in principal, right?
Right, right. Yeah.
So that is another thing. So companies were getting very low interest rates borrowing outside, but since the rupee was a weak currency, they were losing, they were having to repay more in principal, and that, if they didn't hedge, could have been a problem. Yes. So these are the things you worry, and that's why you need to hedge. Okay. So this we already discussed. Okay. Okay. So long hedge. So when you do a long hedge, if you have different futures price, let's say you hedge it today, so your ultimate cost of the asset is basically the final asset price minus difference in the spot price and difference in the futures prices, which is basically your initial futures for price plus the basis. So anyway, don't worry about all of that. So let us look at examples. Yes. So ultimately, it will work out to the same thing. Yeah. When you hedge, you are protected against price fluctuation in the future. And so we will investigate that. So how are we going to hedge? So basically remember, you're going to hedge by selling with a futures contract of some sort. So which contract should you choose? Basically your time frame. Yeah. When is your hedge required? So IT companies typically bring their money back maybe at the end of the quarter. So at that time, you want to make sure the exchange rate does. So maybe it makes sense to do that. Some people say use a highly correlated futures contract. Yes. So whatever, the time frame usually will determine. Yes. Okay, here's an example where we are looking at hedging, but we are not looking at basis risk, right? So basis risk happens when spot price and futures price differ greatly, and the difference keeps changing. Okay, so basis is nothing but, right, spot minus futures, right? So if this keeps changing, then there is basis risk. So in this case, we will assume that doesn't happen. Yes. And anyway, students, this I will take up in the next class. We have done quite a bit. I did not give you a break. We have been going at it from 9:30. Thank you. So we will take this up in the next class. So now I will throw it open for questions, comments, any other things. Yes, students? Any comments, thoughts? So we have finished 2 3-hour sessions right now, 6 hours. So there will be another 24. This is expected to be a 30 credit course. Sorry, 30-hour course, meaning 3 credit. Any questions, thoughts, anything you want to say?
Sir, for additional reference material, we can refer to any particular textbook which you would recommend.
Yeah, so there is Bagri and Vora, futures and options.
Okay.
That textbook is a good textbook written in an Indian context.
Okay. Okay.
Hull is very good as well. I'm using Hull's material, but Hull can be a little complex to understand. Bagri and Vora writes it in very simple language.
Okay. Yeah. Thank you, sir.
Sir?
Yes.
Could you spell the notebook in the chat?
Yes, I'll do that.
Thank you.
I just sent you the link on Google Books.
Yes, sir. Got it.
Yeah. Any other questions? Students, do WhatsApp me if you have any queries anytime.
Sure, sir. Yeah.
And-
We'll go through the material ones and in case we have issues. Yeah.
What is that?
I said we'll go through the material ones.
Yeah. Anything you require, any help I can do, give you, write you letters of recommendation or whatever to help you with your future career, please WhatsApp me and connect with me on LinkedIn if you want. Because I'm networked to many of the Ramaya alumni. So you can, who are doing pretty well. So you can do that. So you can connect with me on LinkedIn and I can help you out anytime.
Sure, sir. Yeah. Thank you so much.
Thank you.
All right. All right. Fantastic then. All right then. Take care. We'll see you next Saturday then.
Yes, sir. Okay.
Okay. Bye.
Bye, sir. Have a good day.
You too. Bye.
Bye.